What I want to show you first and foremost is my screen. I've doubled the number of slides from yesterday. So those who were on yesterday's live event, you'll see that what I've done is doubled the slides that I have. And the reason I've done that is I wanted to expound upon some of the concepts on trading and what makes great traders. Now, as I said yesterday, I'm going to use my know-how personally as a hedge fund manager. I launched in 2004 with a equity long short Cayman domiciled fund, and then Cayman became a dirty word, so we stopped that, and we then migrated it to Luxembourg. We have a UK company because I live in the UK, pay my taxes in the UK, so all those profits from offshore are brought into the United Kingdom where I live and reside. Also, more importantly for all of you, I'm going to use trading strategies from 10 of the world's leading traders who I interviewed for my book, Mind of a Trader. Now, let me know also if this is your first time on one of my talks. And if it is, just put it into the chat box, and so I know what proportion we've got on here as well. So you should be able to see the screen live and clear, as it were. And what I want to do on this is basically improve your trading skills. For those of you who are looking at trading because you've never done it before, all the way to those who want to become hedge fund managers. So it's a pretty broad spectrum I'm going to be addressing today. And Gary, you're a first time, that's no problem at all. Whichever, whether you're new or not, this is going to be settled for all of you. Russell, Stephen, Ian, Edward, Deepika, Jeff, John, Betty, John, David, Alan. I'm sure half of you are watching the cricket or the tennis at the same time. Don't do that. We're talking about making money here, so you should just be watching this. Bahrain, Julian, fantastic. So this isn't, as you can see from the notice on there, isn't individual advice, because obviously I do not know you individually, so I can't possibly give you individual advice. This is educational, and that's what we're focused on. This is something which is quite interesting. But EFinancial Careers noted that top quant PhDs are getting $400,000 pay packages to become e-traders. The whole world of trading has changed from the time when I wrote this book about a quarter of a century ago, Trading Online, which the Financial Times published, and big fat book became an international bestseller. And I'll give you the best bits of that knowledge as well. And we've kept up with what's happening in quantitative trading. And I'm going to share that with you. You might say, well, wait a minute, we're retail clients. We've got to keep it simple. Yeah, we're going to get rid of all the bits which aren't relevant to you and focus on just the bits that are. And for those of you who are thinking of a career in finance, have a look at that website, efinancialcareers.com. This webinar is not sponsored by them in any way. What is trading about? Well, it's really about a very simple notion that I want to give to you. You've only got two decisions to make: when to buy, when to sell. Okay, those are the only two decisions you need to make. And that oversimplifies things. What we try and do is say, look, start with a demo account. There's too many people out there risking real capital. Don't do that, because you're bound to lose it and give it to people like me. And I really don't want you, thank you very much, to give me your capital. I'd rather you kept it and you made the profits for yourself instead. So start with a demo account and focus on the skill, not the amount of money you're starting with. The reason that's important is if you can master the skills to grab £100 from the market, then surely you've got the skills, or $100 or whatever else, then surely you've got the skills to grab 200. If you can grab 2, you can grab 4. If you can grab 4, you can grab 8. What we need to work out is, okay, well, that's one thing. It's skills-based, and we'll worry about the money later. We'll have to worry about it at some point. Obviously, it's pointless doing it if you've got no money. The other factor we're going to look at in this webinar is, well, if a coin's right 50-50, then how can we just nudge ourselves to be a tiny bit better than a coin? Is there anything out there, any data, any way of looking at the markets which just puts things a little bit more in our odds, in our favor, than otherwise would be the case? I mean, a bit like a game of poker. If you learn a few little tricks, you should have the odds a little bit better in your favor than if you're a complete novice and are just throwing it about there. One thing which is true, and I can tell you from the world's leading traders, and I said the book interviews them, so you've got evidence of it. And when I first wrote that, when I was a student at university, the reason I wanted to meet those traders is because I knew if I wanted to trade for a living, I better meet the world's leading traders. And one thing that I discovered from them, which really shocked and surprised me, was that they weren't right all the time, or even 9 times out of 10, or even 8 times out of 10, or even 7 times out of 10. And that really surprised me, because I thought they were going to say, Alpesh, we're just really good, we're very clever, we know more than everybody else, and therefore we're just right all the time. And what we do is take massive bets for when we know we're going to be right. Now, of course, there are some people in the hedge fund industry who cheat and have been caught and have been doing that. They're right all the time and they get caught out, and they've been cheating. They've been using insider information, or they've been bribing lawyers, or searching dustbins late at night to get an edge in terms of who's doing the takeover bid and whatever. I'm not talking about the cheaters and the liars and the frauds. And you might say, well, that's pretty much the whole market then, Alpesh. Well, put that to one side. We're talking about just being a little bit better than a coin. So how can we do that as a retail client? How can we put the odds slightly in our favor? And I'm going to suggest you use 2 approaches. One is, of course, the approach that I use, which is rely on what worked for the leading traders. And then you want to know, well, what proof do you have? Well, there's the Financial Times book. And I'll give you a free downloadable copy of that book in this webinar as well. The second approach you want to use is just the logic I'm going to show you, because you're going to see the math and you're going to say, oh yeah, shit, that works. And that, of course, makes sense. And those are the 2 elements that I want to focus on in this webinar. Okay. So let's first of all start with how people in trading lose money. And you're going to see me focus a lot on losing money in this webinar. And it's not like any webinar you've ever seen before. And you might say, what the hell's wrong with you? Why don't you just tell us the magic secret potion and the magic beans to make lots of money, and stop talking about demo accounts and how people lose money? Well, actually, successful trading is about making sure you don't do all the 80% of ways there are of losing money. And there's 80% of ways of losing money, because we know this, because we know 80% of people trading lose money. We know this from the regulators. We know this from the FCA data. We know this from the stockbrokers, because they have to put it on their homepage, where they'll say, 80% of clients lose money with us trading. So 20% are making money. So what are the 4 ways in which people are losing money, and what's the 1 way out of 5 that they're making it? Because obviously statistically that must be the case, because we've got the data from the regulator, we've got the data from the brokers. And you might say, well, brokers are lying. Well, they're not going to lie about how that many losing. And if they're lying, then the regulator isn't going to lie, and they're not going to be in collusion unless you're some kind of mental conspiracy theorist. So let's look at the 4 ways in which people lose money, so you avoid them, because I'll save you a hell of a lot of time. If you're looking for a new way of losing money, go look elsewhere. Go on other videos on TikTok or something. And by the way, before we get into the 4 ways of losing money, just give you a quick update. Yesterday, I mentioned the DAX, and I said, I don't know why it is, but the German index is the easiest thing to trade. Now, when I said that, I had no idea what was about to happen, which is, remember we said we were short. That red arrow means short signal. That we had trend following momentum trading. I'll explain all of this. This is the 1 hour bar on the DAX. And if you remember from yesterday's video, you'll know that we were short yesterday, and now it's just accelerated downwards significantly. And that red dotted line is where we add to our position, because we've got some prop. We always start with a small position. Always start with a small position in case we're going to be wrong, because we don't want to lose a lot of money. Newsflash, man does not like losing money. And then we add to that winning position when we get there. Now, that's not something I invented. That's just what I was taught by, as I said, the world's leading traders. I just copied what they did. So if you're looking for some kind of original thought from me, you're not going to get it. What you're going to get is a repetition and replica of what the world's leading traders do. Okay, that's all I've ever done. I've never tried to invent or improve upon what they do, because that'd be way too risky, and I don't like taking risk, and neither do they. So that's what's happening. We'll do an update on all of this, and I'm just using a free retail platform here, which is broker independent. Okay, so we're not tied or affiliated to any broker, and it's free. So it's not as if it's affiliated to, oh, okay, you just got to pay a subscription to somebody. Nope, nothing like that needed. None of that bullshit. And when I used to write my column in the Financial Times, I'd try and give these free tools, and there's many more. We can do that in the Q&A. The free tools that I like on the website. So we're looking at a screen title, how traders lose the praying toes. Should we be looking at them on the side? No, that's the correct slide, Lisa. Somebody said your screen isn't showing. Should be showing. So how traders lose. Oh, wait a minute. No. Lisa's absolutely right. You're absolutely right, Lisa. I didn't show. Let me just turn the screen share on again. It's the entire screen I wanted to show. And you're absolutely right, Lisa. Sorry, you're absolutely right. What you should be looking at. And I'm going to put this in, and then I'm going to show this. That's what I meant to do. You're absolutely right, Lisa. So let me go back to DAX, okay? And that mistake won't happen again. So here we go. And that's the DAX. And that was from yesterday. And you'll remember what happened is I said the DAX is ridiculously easy. And I also said, to make the point, that I don't care what I'm trading. I don't care whether it's the DAX or US dollar or Microsoft. In fact, I prefer indices and I prefer currencies because they're more liquid. And this has now accelerated lower from where it was yesterday, and it proved me out. And that's actually been the best trade of the basket of trades from yesterday, and we'll go through all of them again later on. You can see which ones we looked at yesterday, and we'll go through these again in the webinar and how the positions have worked out since yesterday. Okay, so don't worry, don't worry about all of that. We'll do that a little bit later on. So let's go back to how traders lose money. First of all, the praying trader. This is the person who says, well, you know what, and you can do these experiments at home if you wish. And I suggest you do it a demo account because you're going to lose money on 4 of the 5 different ways. But this is a common thing which people, they go on social media, they say, oh, I think I know. They pay £2,000 for a course and they say, I think I know how to make money. And they say, all I've got to do is have my reward at least double my risk. Simple. So they do 100 of these trades. And don't take my word for this. Statistically, just do this yourself. Do an observation over the next day, 2 days. Doesn't matter whether it's a 1 hour bar or 1 minute or 1 day. Doesn't matter. Do 100 trades. 10 of those will indeed go from 100. Okay, the starting point here at 100. They will indeed, 10 of them go from 100 there to 200. And you'll make 100 points. Okay, so you do 100 trades. 10 will indeed give you 100 points. You'll make $1,000. 90 of them will go down here. Now, you don't have to take my word for it. Just do it. Practice it. I can give you a whole bunch of statistical reasons why. And it's nothing to do with, oh, there's market efficiencies. There are pockets of market efficiency, and this is one of those market efficiencies. Otherwise, everybody'd be rich. Okay? I could teach this to my 5-year-old son, and he'd be stupidly rich. Right? If it was this simple. So we're not going to do this, right? For those of you who have come across this and, oh, that's the way you make money. You're wrong. It's not. How else do traders lose? Let me show you another way. This is the nervous trader. So we looked at the praying trader. Now you got the nervous trader. Nervous trader says, oh, I know what to do, Alpesh. I'll just put the stop loss a bit tighter. So, and reduce the reward a bit so it's more achievable. That was the problem. My stop loss was too far, so my losses were too big, so I'll tighten it. And my reward was too far, so it happened too infrequently. So they think they're being a bit smart, and they've evolved a little bit. They've got a bit better. They're a bit clever. That tool was just MT4. It's just free. It's broker independent. You don't have to pay for it. And that's why I chose it. I could have chosen other platforms, but they all cost money. So I thought I'll go with the free one. Okay, so how traders lose, the nervous trader. And they'll do 100 of these. You can do 100 of these yourself. You can run this experiment, run it, put it on social media, and you'll see, oh, shit, this is really clever. Share your research with the rest of the world. And this is exactly what will happen. And I'll guarantee you it'll happen. You'll do 100 trades. 10 will go up to 20. So you'll actually make that money. You will hit them. Okay, and 90, you'll hit that stop loss. And you'll have lost money, not as much as the previous losing trader, so you'll be less of a loser. Well, I've just seen my son at sports day, and I can tell you being less of a loser is still not much consolation, right? So what's the next one? Well, then you've got the dreamer. Okay, they probably went to a former athlete who earned 200K as a sportsman and decided he's going to get into trading and teach others at $2,000 a pop. And this guy has taught you this way. What he said is, look, it's obvious what Alpesh is forgetting. Why have a stop loss at all? Get rid of it. You don't need it. So what this person will say is, we'll start at 100 and we'll set a target of 200 to take our profit. So they'll do 100 trades. 10 will indeed go up just statistically. But 90, they'll probably end up losing roughly about 50. You say, well, wait a minute, it's got no stop loss. No, what's going to happen is with 90 of them, they're going to go sideways. Time's going to catch on, and they're just going to not be able to take the pain. And sooner or later, they're just going to have to cut those, or they're going to get margin calls, or something's going to happen, and they're going to suffer a loss. In fact, this person is the biggest loser. These are the dreamers. So we've got to avoid doing this. I know what you're thinking. Oh, well, just tell us how to do the right way. Well, there's a reason for the build-up. Okay. Then there's the scalper who says, haha, I've noticed a pattern here, Alpesh. I found the solution. This is the answer. What we do is, yes, indeed, we have a stop loss, and we don't have it too close because I saw the errors there, gets hit too often. Put it a bit further away, but we still have one. and we put the reward really close. Dunno. And this person gets the dopamine hit because they do 100 trades. Okay, and what happens? The dopamine hit they get 80 of those trades do indeed hit their profit target. Fantastic. And they feel all great, and they tell they tell their spouse, hey baby, I just keep winning. Look at me, 8 times out of 10, 80% of the time, I'm a winner, baby. I just win. And what they will always neglect to mention to everybody is the 20 positions which just keep going lower and lower. Okay, and if they were to ever mark to market and see how much losses there, and they say, oh, don't forget about those, Alpesh, I'll just top those up with my income. Just ignore those losses. They're just paper losses. They don't really exist. If I live for infinity, I will always earn that back, so it doesn't matter. But they'll be a loser. Now, they won't be as bad as the one without the stop losses. They're sort of, you know, second worst loser. Not the worst loser, second worst loser. So not too bad, but they're still bloody losing. So what is it then? That's the 4 ways in which people are losing money. Which way are they actually making the money? Okay, because that's the obvious one. Well, we're going to come to that. Don't worry, it's not a tease. I'm building up to, okay, well, if those aren't the ways, and you can put it in the chat box which ways you think might be the ways they're making it. The reason most people are failing, and we're going to cover all of these things, is first of all, they have the wrong broker. And we'll deal with that. Just make sure you never have a Cypriot broker, always UK, FCA regulated, or German's okay, or Australian's okay, or US is okay. Okay? They'll try and trade around news. They'll only look at charts. They'll have bad teachers. They'll have bad strategies. So let's get rid of all of those ways. Right? And like I said, everything that I'm going to talk about has been due diligence, and you can due diligence it yourself through my various books published by the Financial Times or my columns or whatever else, because like any sort of researched approach, it should be verifiable. So the kind of trading we're going to look at is going to be momentum or trend following. Why? Well, because for retail clients, it's the easiest. I mean, do you really want to look at cross-exchange arbitrage? Do you want to look at merger arbitrage? Do you want to look at options trading? It's going to be a bit messy and difficult, so probably not. Now, imagine you've got the price doing this. Okay, it falls. I've just done a simple stylized version, and I did this in one of my FT columns to explain. If you get in there, then obviously you discover in hindsight that was too late, right? What we're trying to do is not get in at point X, because what we've discovered is, well, at point X, things might keep falling, and you just never know if they're going to keep falling or not. Sometimes they go up, sometimes they don't. X actually, while the market's still falling, generally tends not to be a good place on a risk-reward basis. Now, you can disagree with me. Go ahead, find a new way of losing money if you wish. We're going to try and get in at point Y. Okay, well, how are we going to find that, Alpesh? And why do we want to do that? Well, because what we're looking for is from it to go from Y to Z. That's the playground. That's all we're going to focus on. You might say, well, no, I've got a million other strategies. Fine, good luck to you. Go play with your million different strategies. We don't need a million different strategies. You just need to get one right, focus, easy, simple. And one of the secrets to success is obviously focus. Now, even then, you're not guaranteed a return, because it could go up a little bit and then drop back. But at least we know we won't be too early, which is point X, and we won't be too late, which is leaving it too late. Okay, so that's what our focus is. We want to go, we're not going to do these. We're going to go from that one, hopefully into a load of 3s, and we might end up having some 4s, but at least we've removed these out of the way. So we've reduced our losses already. So how are we going to do this? That's all very well in an academic format. How are you going to bloody do this in terms of practicality? Okay, and that's what I'm going to show you in this. And by the way, if you want to download the book completely for free, there's the links. If you want to download Mind of a Trader with lessons in trading strategy from the world's leading traders, it's completely for free, so you can check me out. And if you want to check me out on LinkedIn, follow me on there. I only connect with clients, so if you're not a client, don't bother sending an invite to connect. But you can follow me. You can follow me on there. You just click the follow button. That's out of date. It's about 20,000 followers now. Okay. And this is who we're going to rely on a lot. Bill Lipschitz was global head of foreign exchange trading at Salomon Brothers. He was my mentor because I interviewed him in the book. That's how I got to meet him, and basically got to ask him, okay, how do I get ridiculously rich? I was a student. I was about 26 when I first interviewed him in New York, and interviewed him at the Berkeley Hotel in London as well, and at the home of Mark Slater in London as well. And at that time, he lived at 77 Beaker in New York. So I interviewed traders from New York, Chicago, and London. And you can download that for free on the link I just gave you. Okay, his chairman at the time was one Warren Buffett. I never met Warren Buffett, but Bill Lipschitz was global head of Forex trading at Salomons. Him and the others who were in the book, like Bernard Opperty, David Kite, massive legends, and I'm going to share with you their wisdom. And you might say, well, why would they ever share anything with you? Well, actually, it's not a new thing. Sharing strategies is not new. We have to share our strategies with every institution that we ask to invest in us. We've got pension funds, we've got family offices, and when we're explaining what we do, we have to share our strategies. They're not going to just give money to us because, you know, if we say, oh, just trust us, mate. So we're not the first, we're not the last. In fact, there's many far bigger than us who have shared their strategies. Strategies are not the scarce resource. If you want more trading strategies, go to Oxford University Maths Department. You'll get loads of market strategies. They're not the scarce resource. The scarce resource is capital, is money, is getting the money behind it. And we'll deal with that in a little while. Okay, this is from Winton Capital. It's a slide that I've stolen from them because I think they've got more credibility than I have. Why? Because they've got billions under management. I don't. Okay, so what do we have here? Okay, what we have here is how they trade and how we're going to trade. And this is one of their slides that they use to explain to investors how they make money. And it's pretty simple. And given that a multi-billion-dollar hedge fund based out of all places, Hammersmith, but Winton is run by Sir David Harding, and I can assure you they're a very, very credible outfit. I think they're Europe's second or third largest hedge fund. And they use the same way we do and many others. And I'll show you the other hedge funds who use the same approach. We buy after a lag. Now, there are people out there who say, wait a minute, why can't you see into the future and just pick it at the bottom where the trend starts? Well, because we don't have a crystal ball, and neither does anybody else in the market. Okay, so anybody who tells you they get at the market bottom, they're probably just keeping themselves to social media for now and don't want to set up a big, large fund and trouble themselves with it, okay? And those who get in too early, well, I said already, professionals don't do that because the probabilities are it could just as easily go lower. So that's the point we're looking to buy. And the same thing with selling. So how do we do that? What's the strategy for that? What's the business plan, Alpesh? Let's break it down. And by the way, just in case you want to know who does trend following, well, these are some of the biggest hedge fund managers in the world who have trend following strategies. John W. Henry is a favorite of mine because he owns Liverpool Football Club. I'm a Leeds United fan, but the reason I say that is a big UK investor. David Harding, right up there, British. And of course, Man Group is British headquartered as well. The others are all trend following hedge fund managers as well. So, of course, have done incredibly well. Ed Seykota, who I haven't met on this list. Where's Ed? There he is. Turned 5,000 into 15 million over 12 years. But you can Google these people in your own time elsewhere if you so wish. They're all rather famous, and actually they're the reason I got into it. I mean, you know, I saw numbers like this when I was in my 20s, and let's be honest, it was the money which attracted me first. I mean, I'm not stupid, you know, I'm not a communist, I'm not a socialist. It was the money that attracted me to all of this. Okay, first and foremost on trading, and those are the biggest names that you can see there. This is from Man Group, which is a multi-billion-dollar hedge. It's their AHL hedge fund. And this is how they explain it. So I know I might be explaining basics to some of you first. And I think it's really important before I go back into explaining the charts and what was looking like what. And I seem to have sort of closed the window on that. But let me just put that up again. Before I go back into this and the trades that we're doing, let me just show you a bit more of the basics so you understand how not to lose money. And so they explain this to their clients. These are not my charts. This chart is from AHL. I've stolen it from them. Okay, and they manage billions. And they're actually one of the most successful hedge funds in the world. AHL. You can Google it. And the H is Harding. David Harding left and set up his own, Winton Capital, which I just described to you. And all they're saying is they're trying to work out from today into the future, should they go long or should they go short? Now, you might look at this and you might think, but I thought you guys would use quantum mechanics and artificial intelligence. Well, we'll get to all of that later on. And there are people who do all of that. But actually, the first place retail clients need to start is not worry about what to do when they've got billions. It's actually just how do you get from where you start to making a tiny bit. And you can have big money problems later. So this is their slide. And then they had this slide. And they said, well, what they do, and they've just oversimplified it here, because they're obviously not going to reveal their actual strategy. And I'll reveal, we have 10 strategies in the hedge fund, one of which, thanks to Bill Lipschitz from when I met him in the book, and I'll share the first one, the oldest one, not the other 9, but the first one with you in this webinar. So just going back to Man Group, and they said, well, look, imagine for how long it's been going. You had a minus, a minus, a minus, and then a plus. Okay, so if it goes up, you add a plus. If it goes down, you add a minus. So you look at the periods, and is it down from that period? And this is just them explaining it in broad, high-level terms. Okay, it's not their exact strategy, but they're explaining it. And then what they'll do is they'll top that up and they'll say, it's a -2 because we've got -1, -1, -1, +1, that's -2, and therefore we should go short. They do that across every possible outcome, and every possible outcome you can see on screen. If it's always just falling, then they'll go fully short. If it's always just rising, i.e., they'll follow the trend and go fully long. And if it's somewhere in between, which it usually is, they'll go partly long and they'll add, well, I'll tell you in the webinar what they'll do because we do it. We copied what they do, okay, as much as we could without knowing their exact formula. It's a bit like somebody invented Coca-Cola and we reverse engineered as much as we could the taste of it. We gave it to scientists and they said, okay, here's virgin cola. It tastes, or Pepsi, it tastes a bit like it. We said, yeah, that's good enough. And good enough is fine in the world of multi-trillion-dollar markets. Good enough is fine. It'll make you enough, okay? We're not going to try and be greedy and be the world's largest fund, are we? So how does that now translate into something you can use? And by the way, all this free education is part of my campaign to teach 1 million people how to invest. And I've been doing it through my books. So you can download them for free now on the link I gave you earlier. I've been doing it through my newspaper columns and through these webinars, all right? So just so you know. And one of the things that I've also been doing, that's me trying to look cool. That's us in Vegas after Raj won 20 million pounds because I was the expert witness who was able to prove in court that momentum strategies actually work. Okay, so what I'm teaching you is something I was able to show in court. Now, I don't know anybody else who's been an expert witness in court and actually proven that those strategies work. He actually sued for 90 million. He didn't get 90 million. He got 20 million. And then we parted hard I should say I'm a teetotal vegetarian. So when I say we parted hard, we stayed awake for about 3 nights straight. Anyway, so I'm going to share with you what's actually been proven in court, which is pretty extraordinary, actually. Now, you're going to start off being interested in trading because you want the money, you want the funds. But actually, eventually, it gets to fun, freedom, and fulfillment, and hopefully a bit of philanthropy as well. And that's important. Those things are important because otherwise you're not going to do it. You're not going to do it if it's only you think it's the money. You think, oh, I'll just do it for the money. You won't. You'll get bored and you'll probably give up at some stage. Okay. These are the reasons most people trade: side income, leaving a day job, something to learn to do. These are the problems we're going to address in this webinar: how to trade, which brokers, when to buy, when to sell. So let's get on with those parts. These are the numbers you need and that I want you to follow. Then I'm going to give you the entry strategy, the stop loss strategy, and the business plan. Okay, which fits in with how you don't lose money, so you can cross-verify with everything that I've said and said, oh yeah, shit, that makes sense. You're either going to listen to my logic or you're going to cross-reference with what the world's leading hedge fund managers have said in the book. So you can do your own due diligence and say, yeah, actually what Alpesh said, that either makes logical sense or actually it's exactly what Bill Lipschitz said and he's just programmed that into an algorithm and that actually makes sense. Okay, so I don't need you to trust me for anything. Now, you're going to look at the markets for 15 minutes a day. Why 15? Well, we discovered from Pat Arbor, who was chairman of the Chicago Board of Trade, and he was in this, but also the other leading traders, that when they put their traders in front of a screen for too long, they ended up trading out of revenge because they'd lost money, or out of greed and arrogance because they'd made too much. So they limited the amount of time that they could place the trades, and then they told them, now bugger off. In fact, most of them went home by about 11 o'clock. Saying the floor traders would be probably on the way home at about 10:30. Because it was just no good. It's like trying to be an air traffic controller. You're just going to blow your brains out if you're just in front of the screen too long. And that works out well for retail clients because you've all got a day job and better things to do. So you're going to scan these for 15 minutes a day, or you might do a whole hour on, say, a Monday. Okay, so 15 minutes a day before and after work, or an hour. And you're going to place some trades. How many trades and how do you know which ones? Well, we'll come to that in a second. But first, we're dealing with the 15-minute issue. So let's just, how long do we need to be in front of the screen? Let's just address that. Then scan 12 to 20 instruments. Well, which instruments, Alpesh? Now, I'm going to suggest to you which ones I like. Okay, I really like. Now, I said to you yesterday, if you're watching, I love the DAX. But I don't know why it trends so easy. Look at that. Why would I not love that? Okay, I don't know why. Maybe it's a German thing. It just trends really nicely. Beyond that, I don't care what you trade, because it's like being in a supermarket. When you're buying and selling a lot of different things. Who cares? If you've got the profits are profits. But some people are obsessed with, I only trade oil, I only trade gold. Well, no, we're following trends. It doesn't matter what you trade. And by the way, from yesterday, we had the FTSE, and the FTSE's collapsing as well, which I said, FTSE's ugly. By the way, you can see some trades, and they don't always work out. Look at that. That didn't work out. But losses should be small in size, short in duration. Okay, small in size, short in duration. There were 2 trades there that just didn't work out. Well, you could argue 3, 1, 2, 3, that didn't work out. Okay, well, how come you're not right all the time, Alpesh? You're rubbish. I don't have a crystal ball. These did, and to be honest, if you've been following my YouTube or Telegram channel, you know I've been calling short on the FTSE for bloody ages anyway, on the longer term. But even in the short term, it's just collapsing, and it's dropped, 200 odd points. Well, that's a shitload of money. Thank you very much. And it's my birthday month, so thank you, FTSE, because you've made it a very nice birthday month. And I've said it before, say it again, those are the trades. US 30 short, that was long yesterday, and nothing came of it. Look, we didn't make money on that long. So the live trade from yesterday, there's one that didn't work out. One thing that I discovered, and you can find this from George Soros's book, Alchemy of Finance. If you look at his diary, he's wrong a lot, and he has no ego about it. I was wrong on the Dow from yesterday. It didn't go up. I have no ego. I don't care if somebody goes, you're rubbish. My friend, I've got my bank balance to keep me happy. Now, that's a short, and that's just plowing lower and lower. Fantastic. So how do we know where the stop loss should be there? How do we know when to add to a winner? How do we know when to enter? Let's address all those issues. But first of all, just keeping it very structured. Okay, 15 minutes, 12 to 20 instruments. I want you to look at the instruments there, the indices, especially the DAX, and the major versus minor currencies. You don't need to know anything about currency. People go, but I don't know anything about Japanese monetary policy. You don't need to. Major versus minor currencies, or minor versus minor. Okay, that's it. Now, what's a major currency? So you can work out what I just said to focus on. Major, there's 4 major currencies. You can get them: euro, sterling, yen, US dollar. That's it. For those of you who think it's Bitcoin or Japanese yuan, seriously, you've got to get off social media. Right? 4 major currencies. The ones which trend the best are major versus minor, or minor versus minor. And the reason for that is the big banks trade in major versus major, and you do not want to be getting into that fight, because the markets are just going to be all over the shop. International trade is done in major versus major currencies, and so it's not about trading. It becomes about physical goods, and it just becomes too volatile, too difficult to get trends. Okay? So major versus minor, or minor versus minor currencies, plus DAX. FTSE's fine. It's not, by the way, the FTSE's not usually that good, where it just trended and just dropped off, and it's just not that good normally. So I don't want you to think that's typical. Wow, Alpesh's day, typical. He wakes up and it's just the FTSE just gives him money into his account. No, it doesn't work like that. Okay, 1 screen is all you need, 1 trade per day minimum, and I'll give you the business plan for that in this webinar so you can see why. Most of you want to do 100 trades in a day because people like working hard for a living, or they like being stupid for a living. No, you'll do a lot of low quality trades if you do more than 1 a day, and I'm going to show you the business plan. That'll be ample money. 20 trades per month is what 1 trade per day works out at, or 5 in a week. You might place all 5 on a Monday. Try not to have more than 5 open positions at any given time, ideally 3 to 5 open positions at a time, because your brain can't cope. If you disagree with me, like I said, it's just read what the leading traders in the world said about what they do. And none of them knew each other, and they were all interviewed independently. Okay. Our target income is going to be that low level one, that one, 500 to 1,000 a month. There's no guarantee. Some months you make more, some months you lose money. Hear that. If you don't want to lose money, you should not be anywhere near trading. Okay. And that should average out. And you start with a demo account. Until you're consistently making that on a demo account, you should not be using live cash. That's just logical. Why the hell would you use live cash? Okay, unless you're just stupidly rich, which I'm assuming nobody is stupidly rich, because they wouldn't be rich if they were stupid. Right, This, I don't endorse this broker. I don't know them, just so you know. This was something I found for a book I was writing a few years ago, where we analyzed data of, well, from brokers. Do men make more money than women? Are there certain times of the day to trade? Are there certain instruments? If you hold a certain instrument over a certain period of time, are you more likely to then have a loss or a gain? Is there a certain optimal time holding period or time of day to open trades or direction of trade, et cetera, et cetera? So we put all that data together, and I'll share some of that with you in this webinar. And of course, people are attracted by things like this. Don't be. You're not going to, I'll guarantee you one thing. None of you on this are going to earn any of that. Any more than if I showed you the last 20 years of lottery winners, the only thing I could ever guarantee to you is none of you are going to win the lottery. Why would I guarantee that? How can you possibly guarantee that? We might win it. Yeah, if you think like that, you've got a problem. Okay? We're going to go for 500 to 1,000 a month. Because statistically, that is more likely. I'm just playing the odds. And my job is to try and get you into the 20 to 30% who make money. Because we know 70 to 80% lose money. So I'm just trying to get you into the 20 to 30%, which is a pretty wide goal. Given that 95% of businesses, all businesses, fail within 3 years, getting you into a 20% goal is pretty, it should be pretty straightforward. And I'll show you some people I've done it with. And you'll see that, okay, you've done it with people who look pretty simple and easy and don't even have a financial background, and I'll show you them in a moment. So like I said, doesn't matter what you buy or sell, profit's a profit. Never pay a subscription. There's always a conflict of interest. Somebody's charging you a subscription for something, it's because usually, wait for it, they'll say, and use our broker. So they might be selling you software and they'll say, use our broker, don't do subscriptions. There'll be a conflict of interest, and they'll usually have a broker and they're getting a kickback from that broker on your losses. So actually they want you to lose money. You're paying them a subscription, you're going to lose money to the broker, and they're going to get a kickback from the broker, right? That's how it works. Now we know this because I'm from the industry, that this is what goes on, because you hear things about companies and organizations doing it. And by the way, you can put in the chat box if you want names of any individuals or organizations, and I'll let you know what I know about them. But when I wrote in the Financial Times, trust me, as a journalist, you'd read a lot, or somebody write a columnist, you'd read a lot about what goes on behind the scenes. Okay, so let's go look at this, right? So buy and sell. How do we know when to enter, when to exit? How do we know when to buy, when to sell? There's only two decisions to be made. Yet, as you can see from these risk warnings from CMC, IG, and Saxo, actually 61 to 66% of their clients lose money. And this is not just about spread betting or CFDs. It could be options. It doesn't matter how you express the trade when you want to buy or sell. You might even buy the actual physical product. It doesn't matter which. Okay, it's the same principle, especially given that the data you have and they have is going to be the same. Look, there's a sell signal. All these price data is going to be the same for sterling US dollar. You don't get a special discounted price where you can buy sterling over US dollars, and neither do they. So given that one trader might sell here and buy back here and then buy here and go long here, that trader might make £500. Trader 2 makes 5,000. Trader 3 makes 5 million. Why? Well, they had the same prices. They bought and sold at the same time. It was just capital that was different. And my job is to teach you the skills. So the only thing between you and a billionaire trader should be the amount of capital. You might say, well, that's a big bloody difference, Alpesh. Well, of course it is. But at least we've removed everything else and leveled the playing field. There is no other industry or business in the world where the playing field gets leveled so quickly and easily between you and a billionaire as happens in trading. So the only, because you've got the same data, you've got the same price points, the only thing, you've got to make the same two decisions as they do, when to buy, when to sell. That's it. So the only difference is going to be, okay, when do you scale up get your hands on more, when do you rob a bank to get more money, basically, and we'll deal with that part later on, okay? And by the way, given that you've got a choice of so many instruments, so many instruments, like I said, I prefer the indices, maybe commodities, and so on, and the currencies that I mentioned already, but we can talk about that, okay? And this is what we're going for. Now, this is not typical. This was a particularly good, because people will ask me, well, okay, well, how much does trend following, how much can it make? Well, it's not down to me. It's down to what the market gives you. I can't make a trend if there isn't one. And here's an example of trend following where we've actually got, and this was the US 500, so the S&P 500 in December, 1 hour bars. Each one of these bars is 1 hour, and we're going from November until December. Okay, so it's about a 3-week period in end of November to December. It's about 3 to 4 weeks. Okay, that was a losing trade. That was a losing trade. That was a losing trade. And then you get the winning trade. And that was nice. That was a losing trade. Another big win. That was a winning trade. Great. Win, win, win. This is not typical. We would not normally get that many wins. 1, 2, 3, 4, 5, 6 wins. And 1, 2, 3, 4 losses. Okay, 6-4, that would be normal, but you wouldn't normally get that many consecutively. You might get a win, a loss, a win, a loss. You know, it'd be more random and mixed up. And also, what wouldn't typically happen is you wouldn't get such big wins. Okay, do you see those big trends? That's not typical. That's atypical. That's not normal. Normally, you'd get smaller wins, as I'm going to show you in a second. So I just want you to know. So that was a good month. So when somebody says, oh, what's the average? The average becomes a little bit meaningless because the variance is so large, and most people don't understand statistics well enough. So when they're asking the questions, they wouldn't understand the answer. This is what it looks like. If you're going to ever become a billionaire, this is what it's going to look like for you in trading or anything else in life for that matter. If you did 100 trades, a very successful hedge fund, or actually any hedge fund, will have these characteristics. If they don't, they're fraudulent. Okay, and so will all the successful traders. So we asked some of the brokers for my book, well, what do your winning traders look like? And they gave us the anonymized data, and this is what their profitable traders were doing. And there's a very small difference between winners and losers. You'll know this in life. It's a very thin line. I'm going to share with you what it is. The main difference between winners and losers wasn't that the profitable, successful, rich billionaires had lots of wins and were right all the time. People just assume that. They're so wrong. It's not the case. Okay, you and a billionaire hedge fund manager will have maybe 20% big winning trades. Okay, you'll have some small wins, you'll have some small losses. They'll cancel each other out. You might say, well, why would I have small wins and small losses, Alpesh? Surely I'll just be right all the time. No, nobody has a crystal ball. Nobody's just right all the time. Okay, you'll have 20% big wins, then your small losses and small wins cancel each other out. That's the same thing for winners and losers. Up till now, winners and losers in life and in trading will have those exact same characteristics. There's just one difference that we noticed statistically, that we noticed in the data. And the only one difference that we noticed was this: the big losses. The successful, rich, stonkingly rich didn't have any big losses. Private investors had big losses. They didn't have a lot of them, but they had enough that trading overall became either a waste of time because they were basically breaking even, or they were making so little it didn't matter, or they were actually running a loss, and so it didn't make sense at all because of their big losses. Now, it's very simple. If I said to all of you here, can you put your hands up if I removed your big losses, would you be profitable? You're all going to go, yeah, obviously. So the job of the hedge fund manager is very simple. It's have a strategy, which I'll give you, and a business plan I'll give you, which removes the big losses. That's the only thing, because everything else statistically just takes care of itself. So let's go into that and write this down. This is what we're going to do, because I'm going to simplify things for you. See, numbers, acronyms, SELMA. We need to get on top of stop losses so we don't have big losses. We need to know when to enter, obviously. We need to know when, if at all, to take profit. We need to make sure we're not using our mind, because that'll mess us up. We need to know how little money to put into a trade, and we need to know when to add to our winning positions. That's all trading is, okay? And you probably didn't know that. I didn't know it until I met the world's leading traders and put it into the book. And trading has become a passion for me. I want more people to do it, or at least explore it if it's suitable for their risk appetite, at least, because it's my passion. Why would I not want others to share it? Now, this is probably the most important chart I can show you. You might want to take a screenshot of it, okay? And what this chart is showing you, I'm just going to move the live broadcast I've got so it sort of shows clearly on screen. What this chart shows you is this, and this is what we stole this from successful hedge funds because before I was a hedge fund manager, obviously I needed to know what the hell they were doing, and so I just copied them. I cheated. I just copied them. How did I copy them? I actually went and bloody met them. I went through the front door. I didn't cheat by going through their garbage. I interviewed them and put it into the book, which, as I said, you can download for free. I don't need the royalties, thank you. So the first thing, the most important thing that they taught me, which I didn't know was going to be the case, I had no idea this was going to be the case. was volatility-based stop losses. And it's probably the secret. If somebody put a gun to my head and said, tell me one secret, just one secret to getting rich, it'd be the boring concept, the stupendously boring concept of volatility-based stop losses. That's what it would be. And you might say, what the F is that? You've lost me. Well, if you want to make money, you're going to have to get bored for about 1 minute. And it's this. We're going to talk entries in a second. Okay, we'll talk entries in a second. By the way, if you're enjoying the webinar, please let me know. Put it into the comment box. I know you're not asleep and you've not forgotten it. Okay, that's the entry point. A volatility, that's green line, that green arrow tells us where to enter. Why? Well, I'll tell you in a second. And that's what we're going to do in the webinar in sort of 0.5 of it. The stop loss, volatility-based stop loss is this. It's the yellow line. And we get our software just to tell us when we're training new recruits in my firm, we give them this free software, MT4, because it's free. We give them about $1,000 of my money because I can't give them client money and they don't ever have any money because they're new to the firm. And we get them to learn on this platform. So because it's safe, it's like giving them a, if they're learning Formula One, giving them an old Volkswagen Beetle to learn on. And volatility-based stop losses, the more volatile the market, so it doesn't matter whether it's 4-hour Apple, you can see it there, okay, you can see it there, okay, or whether it's 1 hour US dollar, Japanese yen. The point is, the more volatile the market, that means moving up and down here, that's noise. It's just noise. Each period, it's just noise, how much it on average moves up and down, okay? If it's more volatile, it moves up. Moves up more and more up and down. You put the stop loss further away, so you don't get stopped by noise. You don't want it too close, otherwise you get stopped by noise. You don't want it too far, so it's meaningless. So what could that number be? Well, it's the principle that's open, but so it's the principle that's important. But if you want a number, put it at say 2.6 or 2.7 average true range, 14-period average true range. If you really want, if you don't know what the ATR is, look it up. Okay, I don't need to teach you stuff you can find on Google. Okay, that's just one example you could use, but it's a volatility-based stop loss. That's really important. Okay, thank you, Deepika. I'm delighted. Thank you, Kim, as well. So that volatility-based stop loss avoids the major problem private investors have is they either put the stop loss too close or too far, or they don't have one at all. Remember the 4 different types of losers I showed you earlier on? That's the mistake they were making. One of the mistakes they were making. The second thing they do, so that's number 1. You can take a picture of this. Number 2 is volatility-based position sizing. Because obviously, if the stop loss is further away because the market's more volatile, then surely, Alpesh, we're going to lose more money. No, you'd reduce the size of your position or how much money you trade with in that particular trade so you don't lose more money. Now, the genius of that is if the market's more volatile, you're not risk losing more money because you've got volatility-based stop loss, volatility-based position size. That was critical to making sure you never had big losses. There was a third thing that the hedge funds taught me that made sure I didn't have big losses. Losers add to losers. Now, I didn't invent that terminology. It was a hedge fund manager I never met, Paul Tudor Jones, who invented that terminology. But all these other traders told me the same. Losers add to losers. You never add to a losing position. Now, you can argue the toss if you wish with me, but I can do the maths for you if you want at some other time, or I can tell you to download the book and read it. And why did they all say that? It's explained in there. But at the moment, I don't have time to explain why it's not a good thing to add to your losing positions. We're not talking about investing now. We're talking about trading. Okay, investing, you might dollar cost average. That's a different story. Or Microsoft drops 10%, I might buy more. That's a different story when you're investing. We're talking about trading, something different. Okay, losers add to losers, never add to a losing position. So what were the other things that helped us make money? Well, point number 3 was winners add to winners. Now, notice on this chart, you see the green line and you see the stop loss there. That distance is mirrored to this dotted line here. Okay, that is the point at which you would add to your winning position. So you'd start small in case you were wrong and lost money, and you would add to that position a new position of the same size when the price reached that point. Now, you could just tell the broker when you start off, oh, I've got a buy signal, I will buy. I'll put the stop loss here, and if the price reaches this, you can put an order in ahead of time. If it reaches that, please buy more, and please put the stop loss here. Simple. I mean, we just get it all written out so our traders don't make the mistake. They used to have to do this all manually, and then we programmed it into here thanks to a, dare I say, a Russian programmer. This is well before Ukraine. And he programmed all this for us, and we used it as a teaching and a training tool for our traders. I now use it as a tool when, if I'm going to be on the BBC, and you might see me on there talking about the markets. That's the tool I use if they talk, when I'm asked about oil or whatever else, I will use that strategy and I'll talk about it. Okay, using that's the secret tool behind. So I'm not actually looking at all the macroeconomic analysis. I'll let you into a secret. I'm looking at the trend and saying this is the way it's going to go. Right. Number 4, the trailing stop loss is trailing. First of all, it's not fixed. And it's stepped. What does that mean? That means when the entry price goes to this point, this moves up. Now, there are some brokers like FXCM which will let you do that. But ideally, that's what you want to do. If your broker doesn't do a step trailing stop loss, do a dynamic trailing. It's not as good, but it's good enough. Okay, number 5 is momentum-based entry. Now, that removes, so we've dealt with when you add to a winner. We've dealt with how much money you put into a trade. Mind or trading psychology is dealt with because you're going to use a process. So you don't need to try and second guess and be confused. Okay. Limit order is when you take profit. If you're an absolute beginner and you're just learning, then you might take profits at that red dotted line and not add to your winners because it's more advanced as a strategy. So we've done stop losses as well. So we've only got the E in Selma to do entries. So let's move into that. By the way, can I, right at the end, and we're approaching almost the end of the webinar anyway, we've got to do the business plan and the entry and then the Q&A. But after that, in the last 10 minutes, can I show you some software technology that my hedge fund has spun out, which we've made available globally? And our ambition is to get venture capital investment into this at a 30 million valuation, and then eventually in 5 to 10 years, maybe IPO it and have $1 billion valuation on the company, because trading is $1 trillion world business. So you don't have to state to that. It's right at the end and you can leave before it, but I always mention it because it's a personal thing and people then say, oh, why are you talking about yourself? So there's my mum. It's me with the king. She makes a visit in all my webinars. Business plan. Is it all worth it? That's the first thing we need to know before we need to know, how do you know when to enter? Okay. How do you know when to enter? So trading, Bill Lipschitz said to me, is like driving. I don't have a car anymore. I have a bicycle. But my wife has a car and my in-laws have a car and my dad has a car. So I borrow theirs, just so you know. So I don't have this car anymore. But trading is like driving, said Bill, because driving seems complicated. Rear view mirror, wing mirror, steering wheel. You've got all these complexities: clutch, brake, accelerator, gear box, all the rest of it. But you might have an automatic, but still, you've got a lot of complexities. And trading's the same. Selma, stop losses, entries, adding to winners, how much money to put into a trade. Yet we manage to drive, don't we? Anybody who can learn to drive, anybody who can drive can learn to trade. It's as simple as that. And how long will it take you to learn to trade? It's going to take you roughly, as a rule of thumb, the same amount of hours as it took you to learn to drive. Okay? And the same level of determination, because that is your coefficient of learning a skill. And trading is the similar skill to driving. In fact, driving is probably scarier than trading, because you could kill people when you're driving in a big metal box going up 70 miles per hour. Okay, so I'd probably say this is a bit easier than learning to drive. So let's do the business plan and then the entry and then the Q&A and brokers and all the rest of it. So Bill Lipschitz, remember, he was the guy, mind of a trader, global head of foreign exchange trading at Salomons, that I interviewed for my book when I wanted to be a full-time trader. And at the time I was a lawyer. I was training to be a barrister and I was still a student at university, learning what you learn at university. Maximum loss, 1% of total capital, he said. That's what you'll set. This is how we did the business plan. You can create your own. Okay, and this is important because for some of you, you shouldn't be trading at all, because you might say, actually, it's not worth it. What's the point, Alpesh? Okay, so he said, imagine you got £20,000. I said, look, I didn't have a silver spoon. I was 26. I was at university. I'm talking to this multi-millionaire, global head of foreign exchange trading, as I said, and where am I going to get 20 grand from? He says, no, you don't have it now. The whole point of a business plan is you're looking to see, is it worth you going on this journey when you've got a little bit of money? Okay. And I said, okay, that makes sense, because if we worked it on what I've got now, it wouldn't be worth it because I didn't have much. Okay. Obviously, he said, but if you get a trading record going, you might get friends and family who might give you a bit. And that's exactly what happened in my case. Okay, so your max loss per trade would be £200. This is basically 1% of £20,000. So if your stop loss got hit, your position size would be such that you didn't lose more than £200 or $200 if you're in the sort of dollar world. Okay, your win-loss ratio, assume you're a bit better than a coin, so you're right 60% of the time and wrong 40% of the time. Okay, now do not be fooled. People sometimes say to me, so how often are you right? I say, well, okay, we were right 100% of the time. What? How? I said, well, we had a winning streak. It's like tossing a coin. It's meaningless to say I was right 100% of the time, because there are other times we were right 0% of the time. If you toss a coin, which is 50-50 heads or tails, and you get 10 heads, does that mean you're the world's greatest coin tosser? And you're going to start a business in the business of tossing coins? And shall I give you some of my money so you can be a professional coin tosser? No, you had a winning streak. The odds are still 50-50. So do not be fooled between winning streaks and what's the actual probability, okay? So we're not going to, sometimes we might be right 10 times out of 10, but we're not going to base our business plan on that one-off winning streak. Equally, we're not going to be as bad as a coin, because we're going to look at the entry and see how which is the next part of the webinar, how do we get into being right more often, okay, than 50-50. So the next step is, so the average loss is clearly £200. Right? The average loss is £200, 1% of 20,000. The average win, because we add to our winners, remember, we've got a strategy where we're going to make more when we win than we lose when we lose, because we don't add to our losers, we add to our winners. So statistically, we should be making more than when we lose, okay? Not the same. And we know that. And by the way, we're going to dial all these numbers down in a minute. We're going to dial them down a lot. So if you think, oh, this is over optimistic, yes, we're going to dial it down a lot, because what we need to know with our business plan is, if we become really pessimistic on it, is it still worth doing? That's how you judge a business plan, not the optimistic or base case or bull case or best case scenario, but the worst case. Okay, and that's what we're going to do in a second. So let's say you do 100 trades. So you do 100 trades, and 60 of those turn out to be getting you your £300 in profits. And this is all stylized and simplified, and we're going to, as I said, dial it down. So when I did the maths on this, remember I was at university and I was speaking to Bill Lipschitz, and we did these numbers, and I went, oh my God, tell my parents I want to leave university. All I want to do is trade. I want to sit in my underpants in front of a computer, eating nachos, banging away at the keyboard, because the more I magically bang away at my keyboard, the more money I'll make. I was stupid and naive and thought that was the case. And Bill said to me, no, calm down. Don't be so bloody stupid. You've forgotten the losses. And I said, yeah, but look, even if I have those losses, that's still net profit of £10,000 per 100 trades. That's ridiculous. It was more money than I had seen. It was as simple as that. It was more money than I had ever seen. I said to him, this is all I want to do in my life. In fact, I then got really carried away. I said, I want to be a day trader. That's what people want to be. I want to be a trade trader. I was just jumping around. I was at university, remember? I mean, think about how young and ambitious you are when you're at university and you think your life suddenly got sorted because you met the world's leading traders, because that's who you want to meet. And that's how I felt. So I said, well, wait a minute. I met the world's leading traders. If I do 100 trades per week, and there's 50 weeks in a year, because the other 2 weeks I plan to be on my yacht or something, okay, 5,000 trades per annum would mean at £10,000 profit per 100 trades, I'll make £500,000. That's how naive I was. And I know what you're thinking, and you should be. Alpesh, what are you smoking? We're not going to do 90% of that. We're not going to do 3/4. We're not going to do a half of that, or a third, or a quarter, or a fifth, or even 15% of that. So let's say we did 10% of that, so because this business plan is too optimistic. Then that'd be 50K. That's still too optimistic. Even 10% of this is too optimistic. So Bill said to me, keep your day job, continue learning to be a barrister. I think he didn't want to call my parents and say, I've just made your son drop out of university. He said, keep your day job. Let's say instead you did 1 trade a day, or 100 every 6 months, 1 a day, or 5 a week. That's what that is, by the way. Well, then you'd make £20,000 per annum based on those numbers. Well, hang on. That's 4% of the business plan. Not 10%, but 4%. And that's still too optimistic, because remember what I told you earlier. Our goal is about 500 to 1,000 per month. It's only 500 to 1,000. But when you're saying, why? Well, why are your goals so unambitious? Well, because if you can make a 500, if you can learn the skills to make 500, some months more, some months you might have a loss. If you can make 500, then you've got the skills to make 1,000, the skills to make 2, the skills to make 4. And it's getting the skills first that's more important than getting the money. And the money becomes this distraction which destroys you. Okay, get the skill first. So I said to him, I said, well, hang on. That means this business plan works if I make about 1.5% of it. He said, yeah. I said, well, that's a bloody good business plan to have. So then I said to him, what you should be saying to me right now, hang on, Alpesh, if that's true, how come everybody isn't rich? And I asked Bill exactly that. I said, wait a minute, if this is all right, then how come everybody isn't rich? And he said, well, wait a minute, there's something we haven't discussed yet, which is the entry strategy. People have bad teachers, bad mentors, and bad strategies. So I said, okay, let's in this now final part of the webinar, do the entry strategy, and then we'll do the Q&A and brokers. There's my mum again. So it was 1K or £500 or 1K or $1,000 per month we're going for, not 20,000 per annum, I'm afraid. No, that's too much. That's over ambitious. It's just 1K per annum, per month. So we could do about 1.5% of our business plan and be happy. That's a good business plan. And momentum trading, so let's look at the entry. Momentum trading is this. We are that guy. Our entry point is we follow and ride the coattails of somebody else who's moved the market. That one in purple, that big bloke, could be Goldman Sachs or Mr. Market, doesn't matter. Okay, we are not trying to second guess and trade the news and see which way it's going to move, because we'll get that wrong. If you look behind me, I haven't got 1,000 analysts. I can't afford them, right? That a Goldman's has, all the amount of firepower it has to move the markets. We're going to just ride the coattails. That's what trend following is. Somebody else starts the momentum, we get into that and we ride their coattails. We won't make as much as they would because they got in earlier, but that's fine. And that's what all of this is about that you see on screen. So I asked him, I said, well, Bill, how do I measure the strength of momentum? How would I go about doing that? And he said to me, well, actually, and by the way, just put into the webinar, have you all got an extra 10 minutes? I'm only going to take 10 more minutes of your time. Okay, have you got 10 minutes more? Just put it into the chat box so I can see that you have. Otherwise, I'll assume nobody's here and I'll just go and have a tea. How to measure strength and momentum. And he said, well, measure how close to the high the price closes in that period. And I said, how? Why? Why is that important? How do I know that trend's coming? He said, it's a bit like one of those charity auctions. I've got a yes. Brilliant. Thanks, Gary. Thanks, Max. Thanks, Deepika. Thanks, Jagdeep. Thanks, Kim. He said, it's like this. You know those auctions you get on TV? I've got a 40, anybody give me 50. I've got 50, anybody give me 60. I've got 60, anybody give me 70. If the price is closing near the high, that suggests there's a momentum to take it into the next period. And we depicted it like this. Okay, I'm just going to show you. Let me just show the image. It's like this. If it's closing near the high, okay, the open and close is there the wrong way around. If it's closing near the high, so I got a graphic designer to do this. That's right. Okay, if it's closing near the high, it suggests the price is going to keep moving up. If it's making higher lows, that's another way. If it's making higher highs, that's another way. So I said to him, well, that's 3 different indications of momentum. And I'm sure there's many others. He said that there's many complicated ones, which you're not going to be able to do. You could do volumes, you could do chart patterns, you could do artificial intelligence. But he says you're not going to do those because you're dirt poor for a start. You need simple. So I said, well, wait a minute, there's still a problem. What am I supposed to do with a magnifying glass? Look at price charts? That won't work. How do I work out that momentum? And he said, what you're going to do is you're going to do the same thing the biggest hedge funds do in the world. What they all do is they don't just look at one indication. They look at multiple indications, okay, of whatever it is they're looking for. In this case, momentum. So they might look for higher lows, higher highs. Is the price closing near the high? And they'll look for other things as well. They'll have their own Coca-Cola formula, right? So he said the reason they look for multiple indications is for corroboration, for extra evidence, for due diligence, for checklists, for filtering. So they are less likely to make mistakes and pick bad trades. And I said, well, that logically makes sense. If you look at one thing, you could make an error. If you look at 3 different things to turn up at the same time, the chances of being wrong are reduced. So he said that you're going to look for multiple indications of momentum, but not the way the textbooks do. Because I said to him, you know, I need cheap, free software to be able to do this. I'm poor, you know, as a student, no silver spoon. And he says, you're going to do it in the way the textbooks don't, okay? Not the way textbooks do. So I'll share that in a second. The other thing you're going to have to do, which all hedge funds do, is they don't just look at one time frame. They look at the next one along. They look at multiple time frames. Now, I was the first one to put that into a book. ever anywhere. Now, many people copy my books, and that's fine. So if you were to look at the Dow, what happened over here when we went short is it wasn't just, and this is the 30-minute bars. And by the way, my favorite time frames, I'm going to show you the data on it in a second, the 30-minute, 1 hour, 4 hour less so, because the signals come so infrequently, but 30-minute and 1 hour, and increasingly in these markets, sometimes the 15-minute, but 5-minute, the trends are too short, and it's not worth the effort. 4 hour, the trends are too infrequent, and therefore you can get bigger trends, but they happen so infrequently, you're taking too much risk in them. So what happened here by going short was not just this time frame did there are multiple indications that the market was falling, and I'll show you what those are in a second, but also in the next time frame along. So not just the 30-minute, but in the 1 hour as well, and so on. And that's the case for all of them, whether it's a long or a short position. Multiple indicators or indications, not the way the textbooks do, and I'll come to that in a second, and multiple timeframes. And the third thing he said is, which all hedge funds do in trend following, is PC, which I'll explain also. So let's just look at what those indications are. Well, there's many different complicated formula for it. Now, tell me, do you need to know how an engine works in order to drive a car? Look at Granny driving a car there. You don't, do you? Now, if I said this is a formula for working, or just one of many, for working out momentum, it's one, it's not the only one. Do you need to understand it and remember it? No. Okay, and it was similarly when we were looking at is the price closing near the high, we looked at indications or indicators which were already available, but not the way the textbooks looked at them, because they don't, in and of themselves, no one of them ever worked often enough. So that's why you filtered. You waited until all three of them. So in this case, you could look at, say, something like a moving average convergence divergence, not the way the textbooks do, though. We were looking to see, is it flat to rising? Because some of them are too premature, some of them are too lagging. And we found that if you got the happy balance, which is you just look to see, was the indicator flat to rising, not the price, the indicator, I'll show you in a second, then it suggested that the price was closing near the high, it was making higher lows and higher highs. And it gave us corroborative evidence. So multiple indicators, not the way the textbooks do, across multiple timeframes. That was our Coca-Cola formula. And it looked like this. We just got the MACD. Is it flat to rising? Multiple timeframes, multiple indicators. So not just the MACD, the stochastic as well on that time frame and the next. And you might say, hang on, but you said they don't work. Yeah, in and of themselves, they don't. What you did is you did it in a way the textbooks don't. So you removed the laggingness of the MACD by just getting it when it was flat to just starting to rise. And you corroborated it with different indicators across different timeframes. That reduced the likelihood of being wrong. But that wasn't enough. We once had somebody say, well, I thought you said MACD didn't work. No, it doesn't. What then removed that unworthiness, as it were, or workaround solution, was multiple indicators, multiple timeframes, and, as I said before, price confirmation, a 2-period price confirmation. Whatever the periods you were trading, whether it was daily charts, 15-minute, whatever, a 2-period high, a 2-period high price confirmation, because it showed that the market was willing to put money into the same direction as you were in. Okay, so when we explain this to traders, and we get everybody from full-time mums to plumbers to business owners to people who want side gigs as entrepreneurs to retirees, professional traders, all the rest of it. That made sense. I perfected this when I was at university. That's when I met Bill. I didn't look exactly like that when I went to see him. That's my last exam, red carnation. Horror. Perfected the strategy. I won awards in the Financial Times. They then said, well, would you like your own column and would you like to write some books published by us? And I said, hell yeah, because I want the profile. Because then I thought, well, if I've got that kind of profile, I can set up a hedge fund and raise capital. And it's exactly what I did. There you go. That's me in the Financial Times winning that. And I wrote a weekly column explaining all of this and then set up the fund, which was paid for in part by Merrill Lynch HSBC. You can sort of see me there. They licensed some of this and they were one of the people to pay me. And that's me in the first set of offices we had at Linen Hall on Regent Street, because I couldn't afford Mayfair or St. James's. And if you know London, between Mayfair and St. James's is Regent Street. And Linen Hall, you could get cheap offices there before we moved to where we are now, which is Brook Street. Now, the best time, by the way, I'll show you how to download this as well in a second. The best time frame to trade, the 1 hour we found, when we gave our traders this, on average, they did about 25 trades a month. Now, some months they did 40, as much as 40, depending on how good the opportunities were. In some months, in quieter months, they might do 16. So the variance is quite large. So don't be fooled by mean. It's really variance you need to look at as well. The net pips captured on average per month was 2,250. Now, this is really, really important that you need to pay attention to. Some months, it was significantly more. It might be as much as 4,000, okay? Might be as much as 4,000. Other months, it might be as low as negative. Yeah, so the average of 2,250 is a bit deceptive because the variance is large. Remember what I said, on a demo account, you want to be able some months to make more, some months to make less, so that you average it out, and you should be on a demo account, not risking real capital, making about 500 a month. If you can do that consistently, then you'd use live cash, because why else would you use live cash? Because trading can make you lose real bloody money, so don't use real bloody money if you can avoid it, right? Win-loss best winning streak was 70 out of 100. That's irrelevant, absolutely irrelevant, as you'll see. Typical maximum stop loss was hit, we'd lose 50 points or pips or points there. Okay, now imagine you risk $2 a point. Don't do that. And everything in trading can be converted into pounds or dollars per point or per pip. If you lost $2 a point, 2 times 50 would be $100 loss. That's too much. There are brokers out there, or there are software people who say, oh, do £1 a point. It's too much. It's because they're getting a kickback from, ask them, how much of a kickback do you get from the broker? They probably won't tell you the truth. Okay, so if you did 2 times 2,250 in a month, you'd make $4,500, wouldn't you? Net pips captured times position size to $4,500. Remember I said we should be making 500 a month, 10% of that. So you don't need to do $2. You can do 20 cents. And there are brokers which will let you do 20 cents, which are FCA regulated. Okay, 20 cents a point. Okay, so you can do a lot smaller in your trade size. And that's good, because then you can get, then your risk is just $10 or £10 a trade, or on a demo account is 0. I don't want you losing any money. So then we had somebody from Barclays approach me and say, look, can you teach me how to do this? And I said, no, of course I can't. I'm busy running a hedge fund. And then he said, well, what if you spun it out into software? And I said, well, happy to spin it out into software, but why would that make us any money? Private investors don't have money. You can't make money out of private investors. You need to get venture capital in an IPO. And he said, okay, do that then, and we'll help you at Barclays. So that's how the Barclays journey started. And I said, well, I'll do it on the basis that I believe certain fundamental things with teaching. I believe that they should have the hedge fund manager, i.e. me, access to me, mentoring, meetings, mentoring, Zooms, whatever, for life. I don't believe in subscriptions. I'll say that again. I don't want any subscription. I don't want any subscription. I don't want them having to pay hotel costs and travel costs, and then somebody, you know, take a load of money off them and then leave them. I believe in lifetime support, lifetime upgrades for free with a no subscription. Okay, no subscription, because I said the whole point of subscriptions is then you've always got your hand in the pocket, and you actually want them to get rich, and they can't get rich or they can't make money if you've got a subscription. So we devised it that way, and Barclays Bank called it Project pipspredator. The idea was they would eventually raise the capital and float it. The man behind it, Biku Aluwalia, he left Barclays. He's a good friend of mine because he bloody got it, and he's a very good friend. He's the best man at my wedding, I should say. And now this is his full time. Well, this and the money he makes off this, and he invests in, does other things. Buy when the price goes above the horizontal line. So that was the software we created. And we created that out of the hedge fund. And a bit like Steve Jobs inventing the iPhone, I think the founder is the person who should say, yeah, this is my baby. This is what I'm proud of. And we think it's $1 billion business in a multi-trillion-dollar industry. Okay. Can it make money? Well, I'll show you some more of the trades. Is it easy? Yeah, you follow the signals. The most ingenious thing it does is this. It removes all the menial task of which trade should I focus on, where should I put a stop loss, how much money should I risk? And it enforces best practice from the best hedge funds, which is never add to a loser, volatility-based stop loss, adding to winners, and so on. And to make that driven home even more, we made sure people had access to me. We created 2 courses as part of it, 2 programs, a 12-week program and a 30-day one, which people didn't have to do. And actually, most people don't. They just read the manual, use the software, and get on with it. And we think we can get a 30 million valuation on this when we've got about 1,000 people through the program. At the moment, we've got about 875 through it. I think when we get to 1,000, we can get VC funding at 30 million to make it global and to make it a bit more user-friendly and so on and all the rest of it. Let me just show you some of the students. Okay, this is one apprentice, 193 pips, including additional positions. Okay, this is 48 hours, 1,930. Now that's the good. I'm also going to show you the bad and the ugly. Okay, and that's when it works out nicely. That's the equivalent of a student sort of coming back and they send me their trades, and we have a whole review channel. They look at, let's look at the down. They go, oh, great, that worked out. But let's look at the ugly. Okay, how do we protect? Because making money is not the problem. It's protecting against losing it. Okay. And here's the ugly and the good. That was ugly. Okay, went nowhere. That was another ugly one. Went nowhere. Went nowhere. Here you can see, how many trades do you see? You see 4 trades. Only one of them made money. Only one. 25% right. Only 25% correct. Only one made money, but overall he made a killing. How? Why? And this is a good example of explaining to people. Any good trading strategy, which this is, should ensure that your losses are small in size, short in duration. Small in size, okay, that's the y-axis. Small in size, short in duration, that's the x-axis or the time axis, okay? That's what they should be. How do we limit that with this? Well, we ensure, first of all, it's trend following, so you can't be wrong for long because the trend would have turned, okay? And secondly, so that's short in duration, small in size, because you're going to trade with a small position, as we explained. So the only thing that's needed for us to teach and mentor the individual is just trade selection, because the indicator takes care of everything else. And what we teach them is how to pick more trending charts. That's the only thing we need to teach their neural networks and their brains, is how to pick more trending charts. So things like the DAX, make sure they do the DAX and the 1 hour. Okay, and you'd be surprised. You can tell people that, but unless you're actually speaking to them and telling them, have you done that? Have you done it? It's a bit like my personal trainer says to me, don't eat chocolates. And if she doesn't keep asking, guess what? I'm going to start eating them. The DAX is making even more for us. So thank you, you guys. You've helped us make an absolute killing today. This afternoon, I'll share the money with all of you. I'm kidding. But that's when it goes wonderfully right. But when it doesn't, this is what happens. You're patient, you're waiting. Why? Because you can't muster a trend out of nowhere. This doesn't magically create a trend. Samir, 523 points. Now remember, it's the additional positions. That's where the real money's made. See those additional positions? That's where it's really made. And that was 3 weeks. It can take longer. If you're doing a demo account, you're not going to make any of that. You're going to make 0. And I want you to make 0 initially, because it proves to me you've got a demo account. Because when you first try this out, you should be using a demo account. We then said, can we make this into a piece of software, a business which can go global? And this was on the jacket cover of my book, Mind of a Trader, that the Financial Times published. And this is what the chairman of the Chicago Board of Trade said. I'll show you how to download in a second. Just give me a second. Gets to the heart of the matter of trading by clearly elucidating the methodologies of successful trading strategies while capturing the ineffable ethos. Okay, clearly elucidating the methodologies of successful trading strategies. We realize, you know what? We have got a moat. We have got a brand and an intellectual property which nobody else out there has, because nobody else has floor traders like the chairman of the Chicago Board of Trade, the world's largest exchange, saying, yeah, clearly elucidates the methodologies of successful trading strategies. Nobody has that level of endorsement. They have Mrs. Jones, an actress from Croydon, or, you know, some fake review somewhere. And we thought, you know, we've got to use that. And he's just one example. We've got hedge fund managers as well. And they put it in print. Then we got normal people telling us, again, thanks so much for writing this to the public. It honestly changed my life. That's the regular comments you expect. Okay, and we thought, this is $1 billion company. So we spun it out of the hedge fund and created it as downloadable software for people to install with all that lifetime entering. Because without an indicator, this is what people were doing. They were looking for one trade at a time and they're working their asses off. With an indicator, it was like having a JCB. Our ambition is to get 1,000 people on the program. Okay, they'll be on it for life. There's no subscriptions. They get signed copies of 2 of my most recent books, physical copies, earplugs to listen to any of the education stuff, but also they get on top of that a trading journal and all sorts of goodies just for trying it, and they get to keep that. Okay, just for trying it, because we want to get to 1,000 people, and then we're at 875 people, and we can then get to about a 30 million valuation, a bit like Dragon's Den. You can sort of say, yeah, now we've got it, and that can take it global. At the moment, we have people from the UK, US. Well, I'll show you where they're from in a second. Okay. That's the person who founded it. Really, he's the inventor behind it in many ways. It was his name that he gave it and the project when he was at Barclays. and I'm delighted. And I was with him last month. And as I say, update June 2023. It's been over 5 years now, and I can say without a shadow of doubt, without Pipspredator, I would not have been able to move to Dubai. I leave my job at Barclays. It's life-changing. And that's what we want it to be. We want this to be life-changing. That's another one. Naomi left university with an English degree and became my assistant. She worked for me for 2 years, and whenever she launches a new fund in the US, well, anywhere, but the SEC filings, she'll always say how she started her career with me, which I really appreciate, and that she worked for me for 2 years, it says in our filings as well. And from there, she went to Newton, and now she's at Polar Capital, and she manages about $10 billion. You can teach investing, in other words, to English literature graduates who are, opera singers on the side. You can teach this to anybody. You can teach it to people who left school at 16, as Bhikkhu did. So my point with this is that this is not, it's like driving. You don't need some special qualifications. My ambition is this is going to be like, Steve Jobs with his iPhone. This is going to be a game changer in the global industry for people to have access to this. And I give 15 licenses each event. Okay, why only 15? Well, it used to be 25, because I'll be the one for the first 1,000. I will always be, and we're at 875. I'll always be the mentor for life. Okay, then after that, when it expands and goes global, there'll be other mentors for other people, but not for you guys. There'll also be, according to what the venture capitalists want, people paying $5,000 a year for the mentoring, $5,000 a year for the software, but not for you guys. That's just for afterwards when it goes into venture capital. Venture capitalists obviously want to have some kind of subscription model, but that's up to them, and it's a problem for later. It's first come, first serve. If you'd like it, we've actually reduced it now to make it more accessible by having installments. It's not subscription, installments. If you want to do installments, or you can just pay in one go. The reason we do it is if we kept it at 0, then people are just not going to bother being part of that cohort. The one thing we ask for you in return, and you get to keep the books, the physical copies of the books, the trading journal, the USB, the earplugs, all the rest of it for trialing it. So we bribe you to try it. The one thing we ask you is this: please give an honest opinion to the venture capitalist when we ask you. That's the only thing we ask of you. If you get too busy and you can't do it, and you say within 30 days, not 7, not 14, not whatever, that you don't want it, that's fine. That's not a problem. Okay, and that's where you go. That's not a problem. The only problem, the only obligation we put on you is that part of it. That please just give the venture capitalist. You can do CFD, spread bets, you can do options. Remember, it's a signal on a trend starting. It might be a trend in the FTSE 100. You might say, I'll buy the ETF. Do you see what I mean? It doesn't matter which one of those instruments you are using in order to do that. That doesn't matter. And people sometimes say to me, okay, simplify it. Well, I'll simple it. Watch the webinar, download the indicator, read the manual. You can do the 12-week course, 30-day course, and they're yours for life, and access to me is yours for life. And people say, well, wait a minute, access to you for life. What that's nuts. And I say, no, because if people are making money, guess what? They don't need to do it. It also differentiates us from everybody else for a very simple reason. If people are making money, they don't need to contact me all the time. And here's the beauty: nobody else will give that in their whatever they're trying to do, because they know other people won't be making money. Okay, follow the signals. More importantly, learn from us trade selection using the signals, and then that's it. Trade through a broker. You can use any broker. If you use one which is FCA regulated, that'll always be good. And we've got videos, got education as well. But more importantly, you just read the manual. I mean, it's pretty simple, isn't it? It's like learning to drive. Okay. By the way, on Saturdays, we do 6 live webinars for apprentices, for students. I call them apprentices. And I also become their mentor in other areas of life. So sometimes we have parents doing it for their children, or we have husbands and wives, and they might want advice on their business, door opening. And I say, look, join me on LinkedIn and I'll open any doors, give you business advice and strategy, whatever else you need as well. And like I said, when I'm on the BBC or whatever else, or CNBC, that's the tool I'm using when I'm communicating with the good people out there. And I'll show you, we've got a dedicated community site and a dedicated website as well on this. Those are all the bits. I want to be either in that list or this list. It's as simple as that. Why? Well, because it's something to do, to be on one list or the other. as well. How often are the apprentice events where we can meet you, Alpesh? Try and do them monthly. So I've got one coming up on July the 20th in Parliament, and you can meet me at that. And what I try to do with those events is do it even broader than just about meeting me. I try and have good speakers who can talk about technology, what's going on in the world, and all of those things. So you get, it's like, oh, well, I met Alpesh. What a letdown. That won't ever happen. But just in case. But, oh, wow, I met all these experts in the world and hedge fund managers and all of this. So we do that. So once a month. As well on that, as you sign up, please do let me know so we can tick you off as well. Any questions, let me know as well on all of this. And I copied billionaires. It was as simple as that. Copied these two who take apprentices. If they do it, why shouldn't I? And what we found is some will be instantly profitable because they've just used to trading. They can follow signals, and about 25% will download it. And this afternoon, they'll email me and they'll say, hey, I'm short on the DAX as well. Thanks, man. We're making loads of money. And that's what's going on. And you can see the DAX is just out. I don't know what's going on with the DAX if somebody wants to update me. And that's the beauty of it. See, I don't need to know what's going on in the macro economy. That simple. Eddie, yours has gone through. Kiran, yours has gone through as well. Kaz, yours has gone through. Stevie, I can see it as well. As you sign up, please let me know and I can give you a shout out. And that will be about 25%. 10% of people will stop within the 30 days. And they'll have various reasons. Suspiciously, weirdly, cancer keeps coming up a lot. I don't know if they think, oh, I better say cancer because otherwise I might not get a refund. Or I don't know, it's weird, but statistically it's improbable how often they say it. But yeah, 10% will within 4 weeks give up. And then by about week 12, we'll have pretty much cleared the whole cohort into profitability, consistent profitability. It doesn't mean every trade's profitable. Remember what I said, the difference between averages and streaks and all the rest of it, but they're confident enough. In fact, it was getting so good and people were making so much bloody money that we decided to increase the price on it. And we also created a dedicated video website of just reviews and video interviews with people, because we thought, you know what, that'll be good for the venture capitalists to see as well. But we had to put the price up because basically people were making, I mean, think about it. Somebody makes 100 grand. Well, actually one guy, and God bless him. Watch Ario's interview. It's alpeshpatel.reviews.com. He made two $10 million companies. And we were feeling a bit stupid because we had charged at the time £1,000. And we thought, okay, we're getting something wrong here. So anyway, you can see the videos. They're all there. And there's a whole load more down there. You'll be able to see the videos and case studies and read some of the students and their experiences on there as well. We have a dedicated website for everybody on there. But like I said, the most important thing is just email me any questions. We create a WhatsApp group with me. We have a private Telegram channel. We have the live events. We have the Saturday webinars, because some people like webinars. Some people like to meet me. Some people like Zoom. Some people like, and we've got a global audience. So, we had to do a bit of everything on there. And most people come from these countries or these regions, including Australia and New Zealand. 80% are in the UK, just because of time zones and they know me and all the rest of it. And that's our ambitions. And we continue giving all this free education because obviously, not everybody wants to, there'll be people who have taken the free education and said, actually, thanks, Alpesh, trading's not for me. And that's fine. And that's an important part of, I don't want to force people into becoming traders because I want them to know whether or not it's for them because I love it. And if you go onto that site, like I said, that's where we are, and we've reduced. But if you've got a company or you're outside the UK, there's no VAT. When we sign up to Pips Indicator, what's the recommended amount of capital? So I'd say start with zero. Okay, just to be absolutely clear, start with zero. We're going to start you on a demo account because I don't want you losing any capital. So the recommended amount is zero. And then you're going to say to me, well, wait a minute, what's the minimum once we're consistently profitable go live? I'd say $1,000. That's what we start our traders with. And say, well, with $1,000, I'll never make enough. You're right, with 1,000 you won't. You're going to build it up slowly and reinvest it into it. And you'll say, no, I want to start with loads. Well, okay, why don't you start with $1 million? Then you'll say, oh, but that's bloody stupid. Exactly. Do you see why it's zero, then 1,000? And you're going to say, well, Alpesh, why are you holding me back? And I'm going to say, well, because I don't want you losing any money. Simple as that, because in trading you can. And what we've also found is when people finesse the skills first and didn't worry about the money, they became better traders than if they were worried about the money. Then they never finessed the skills because they were always looking for shortcuts and they were making errors and all the rest of it. So if you go there, sign up now, what you will find, and this is the first software company that we launched out of the hedge fund. I mean, we have stakes in others, but this is the first one that I spun out and I own. You can do installments, or you can do installments over a prolonged period. You can do it as 24 installments, and there you go. There's VAT if you're in the UK, but if you're not in the UK, there isn't. So there you go. Or you can just do it as a one-time payment if you wish. So anyway, there's a variety of ways of doing it on there. We have a community site on Zendesk that we use where you can post questions, and I'll show you that in a second. And we also have on there, we also have support through a 24-hour phone helpline as well. It's as simple as that. And you get all the goodies. We wanted to create something which basically it was what we do when we're hiring people in the firm and how we get them to that level of competence. We wanted to make that widely available. That was Barclays' idea as well. It was Biku's idea when he was at Barclays as well. Thank you, John. D1 period sold 15678, now 15629. Pip signal. Cool. When we sign up, right? Okay. Any other questions? Let me know. Thanks, John. I take it that's on the DAX. John, you've done it mid-trade, I think. Try and do it when you get the signal. I might be wrong. You might have done it on a fresh signal. But yeah, that's where we are on the markets at the moment. Microsoft's going all whizzy in the markets, I think, at the moment. Disney, I think the US is opening a lot weaker by the looks of it. And to be honest, you could see that coming from the DAX in any event. Where are we on? Sorry, I didn't have that up. So the Dow, you can see the Dow 30. Well, we already had the short. So the fact that the market opened lower, well, that was signaled. We knew that was signaled anyway from yesterday. We got it there. Then this didn't work out. So when this short worked and this didn't work out for us, and then we got another short, we knew, okay, this is definitely going to be a strong short signal because the trend couldn't carry forward and that trade fell. So failing trades like that one can be a really good indicator because they show you that the next one is going to be more powerful because it was clearly just too forceful to the downside. Oh, by the way, for the S&P, I don't think I showed that so far. So that's the S&P. So we are on the S&P 500. Oh, Louise, if it's not going through, it might be that all the licenses have gone, I'm afraid. Just try again. Sometimes it doesn't go through just because it might be at your end, or it might be there's too many people on the website. But it could be that the site's that it's gone. So any other questions, let me know. So that's the S&P. We've got the short signal there before it just collapsed anyway. So that was good. Now there, you'd have to be timely. You'd have to be right in front of your screen because by now you've missed it. But for some, like here, you can see this green signal here. You could have had quite a while before because the price was still near the entry level to get in. So sometimes you just miss a signal. So what? You miss it. You know, it's like I missed an opportunity. But we're short on the S&P 500 right now as things stand. In fact, I better just go off because obviously we just had the US market open. And you can see we were well positioned for it in any event, not least from what happened with the DAX over there. And that's the 1 hour DAX, by the way, we're looking at here. That's the 1 hour DAX, which is still going lower. Great. Perfect. So we had the, there it is. There's the short signal. Short at 1.6. What is that? 1.6. So I'll just use the last three numbers. 286. So short at 286. Actually 6286 and 5719. So imagine you bought something. If we close that now and buy it, we buy it at 5,700 and we sell it at 6,200. That's nice. That's a lot of money. That's a lot of points. That is what, 500 points. And if that was £10 a point, then it would be £5,000. If it was £1 a point, it would be £500. If it was 50 pence a point, it'd be £250. And if it was a demo account, it'd be nothing, but it'd be bloody good experience. And I'd rather you start with demo than risk real capital. Okay. So it looks like the market's getting smashed at the moment, presumably because of concerns over interest rates. By the way, I'll just show you something that we do on the hedging side. So I do happen to have JP Morgan for the long term as an investment. As you can see here, that's a short in JP Morgan, which has now fallen lower. Okay, so that short would have made us money, even though on the long-term investment, we'd be down today. But that short will pay for the longer-term investment, and that's fine. That's one way to hedge. It's a bit more complicated than you need to know, but just so you know how hedging happens. Okay, if there's no other questions, I'm going to go. Sorry, Fat Fingers 157. Fat Fingers, tell me about it. Many thanks for your time. Thank you, guys. I'm going to go. I'm going to just have a look at these markets right now as well. They look great, so it's a good time for us. So thank you all very much. No, Billy, there is no ongoing charges. There's no ongoing charges. It's all the updates, upgrades are free for life. Will there be another price increase? Because we've increased the price about 3 times now. They may well be. They may well be, because we've increased it 3 times. And each time we increase, we go, oh, I didn't think you were serious. I can't believe it. But yeah, they may well be, just because, you know, more people we get through the program, more we see of the amount of money they're making, and it just seems we feel a bit stupid that we're not. But it is still heavily subsidized, because if you look at the staff that we've got behind it, the IT, the engineers, the fact that everything, we're on version 4 and it's upgraded, it's heavily subsidized. And the reason we do it is because, well, we can afford to heavily subsidize it, because we want to get to the venture capital stage of getting a 30 million valuation. It's as simple as that. And that's also hopefully interesting from a business perspective for people to see what we're talking about over there. The 12-week program, I'll just show you that. So you don't have to do it, and it lasts 12 weeks, hence the name. But it's very structured. You click that button, week 1, week 2, and so on. And it's pretty lengthy, and this is more for people who really want to get into trading, who really want to. Some might want to become hedge fund managers. As I say, some have their kids who they want to go into finance, and they use this. And there's a load of stuff here from some of the world's leading hedge funds. We've even got, right at the end of that, let me just show you. You know, help people with careers, resumes, and all the rest of it, or CVs as well. And books are in there as well. So there's a lot of stuff, but you don't need to do that. It's more for somebody who's absolutely fascinated by and loves the industry. And then there's a 30-day program on charting. And we did this because we just took what we used to teach our own trainees in the fund. And we just took that and we just applied it. So I hope you've enjoyed it all. I'm just going to turn off the screen share. Hope you've enjoyed it all. Thank you all very much. And for apprentices, I look forward to seeing you in Parliament on the 20th of July. And yeah, I look forward to. Oh, John, my piece to understand is when to take a profit. Plus, I need deeper understanding on price per pip. Currently doing demo. Oh, John, just email me. We'll go through it. How do I find a broker? Julian, we list a bunch of brokers that we know, but you don't have to use those. Any FCA regulated brokers, so you might use a Saxo, a CMC, an IG. Intertrader are good as well. We don't, you know, Tickmill are good. What I'd say is compare the prices. Sadly, so many of the ones keep going bust. So FXCM are good. ETX went bust, and they were quite good. Intertrader do straight through processing, but email me and we can help you with that. But also for those who are signed up, we have a list which we show them. Avoid anybody who isn't regulated in the UK. In terms of taking profit, you've got the trailing stop loss, or if you want to be in front of the screen, it can show an X where the momentum's run out. So it actually does give an exit signal as well, and that's 2 ways of doing it. But we also show in the manual that if you're a beginner, you might just have a fixed stop loss and a fixed take profit. So there's a lot of different ways of doing things, okay? I'm going to turn off the TikTok version as well. So I'm going to end that one. Okay, and well, thank you all for being on here. I really appreciate it. I will divert away, as it were, to getting onto the markets and looking at some of these shorts. I think one of the psychological things that comes out of all of this is notice how I'm not worried about the market falling, because I'm indifferent to whether it rises or falls. And that is really good from a psychological perspective as well. Okay, thank you all for being on the webinar.